Beneath the surface of global finance, an unseen current flows, a river of capital moving without the light of public scrutiny. Shadow banking operates in the quiet spaces between regulation and innovation, shaping economic power through mechanisms rarely seen or understood. It influences stability without oversight, allowing wealth to shift silently across borders. This invisible infrastructure holds the power to uplift or destabilize entire economies, yet its architects remain obscured. Who controls these channels? The question lingers as we trace the hidden paths of money that shape our world. The geography of finance, where offshore hubs and digital networks converge, will soon reveal how these currents carve their course through the global landscape. The geography of finance reveals the hidden map where shadow banking thrives. Offshore hubs like Luxembourg and Bermuda serve as physical anchors, their tax treaties and relaxed regulations creating fertile ground for untraceable capital flows. These centers act as invisible conduits, connecting global liquidity corridors that bypass traditional oversight. Regulatory arbitrage exploits jurisdictional gaps, allowing capital to flow where rules are weakest, while digital infrastructure accelerates transactions beyond the reach of any single authority. This landscape is not merely physical but conceptual, a network of trust and opacity woven through global markets. Shadow banks leverage these spaces to operate beyond the gaze of regulators, their movements tracing the contours of financial power. As we move forward, understanding these pathways leads us to the historical roots that shaped this system, from medieval credit networks to the deregulated era that birthed the modern shadow economy. The geography of shadow banking, with its offshore hubs and regulatory gaps, didn't emerge overnight. Its roots stretch back centuries, weaving through the fabric of financial innovation long before the term shadow banking was coined. In medieval Europe, money changers and merchant guilds established the first credit networks, connecting distant markets through informal agreements and trust-based transactions. These early systems operated outside the formal oversight of monarchies and religious institutions, laying the groundwork for financial structures that would later thrive in the shadows of regulation. By the 19th century, merchant banks expanded these networks, offering credit beyond the reach of central banks and state-controlled institutions. They facilitated international trade and investment with minimal oversight, creating a blueprint for how finance could function beyond public scrutiny. This pattern accelerated after the Bretton Woods era, when global financial systems began to deregulate, allowing complex financial instruments to flourish. The 2008 financial crisis revealed how deeply embedded these shadow systems had become, exposing vulnerabilities that had long been ignored. Today, the shadow banking system is not a new phenomenon, but the culmination of centuries of financial evolution, where trust replaces transparency and innovation outpaces regulation. As we move forward, the next chapter will explore how deregulation and technological advancements propelled these historical patterns into the dominant force they are today. The evolution from shadow banking's historical roots to its modern dominance was not accidental, but the result of deliberate policy shifts and technological leaps. In the 1980s, deregulation swept across financial markets, dismantling barriers that had long contained complex financial products within traditional banking frameworks. This created a fertile ground for innovation, as institutions began developing instruments that could bypass the constraints of regulated finance. securitization emerged as a pivotal breakthrough, transforming loans into tradable assets that could be bundled, repackaged, and sold to investors worldwide. Suddenly, credit was no longer bound to the balance sheets of individual banks, but could flow freely through a network of shadow institutions, operating beyond the reach of public oversight. The rise of hedge funds and private equity firms further amplified this shift, as these entities capitalized on the newfound freedom to pursue high-risk, high-reward strategies without the constraints of traditional banking regulations. Digital platforms then accelerated the process, enabling cross-border transactions to occur at unprecedented speed and scale. These technological advancements allowed shadow banks to operate seamlessly across jurisdictions, exploiting regulatory gaps and creating a global liquidity network that often outpaced the ability of central banks to monitor or intervene. As a result, shadow banking transformed from a niche activity into the backbone of modern finance, shaping how capital moves, how risk is distributed, and how economic power is exercised across the globe. This dominance, however, has not come without consequences, as the very mechanisms that enabled its growth also introduced new vulnerabilities into the global financial system. The rise of shadow banking has fundamentally altered the competitive landscape of global finance, creating a dynamic where speed and efficiency often outweigh regulatory compliance. Traditional banks, burdened by capital requirements and reporting obligations, find themselves increasingly outpaced by shadow institutions that operate with minimal oversight. These entities offer faster, cheaper credit to corporations and governments, particularly in emerging markets where access to capital has long been constrained by bureaucratic hurdles. As a result, shadow banks have become the preferred choice for many businesses seeking rapid financing without the delays inherent in traditional banking systems. This shift is most evident in corporate lending across Asia and Africa, where shadow banking channels now dominate. Global trade finance, a critical artery of the world economy, increasingly relies on these unregulated networks to move goods and capital across borders. Even major regulated banks, seeking to maintain their competitive edge, often partner with shadow institutions to circumvent restrictions while still delivering the speed and flexibility that clients demand. This symbiotic relationship has created a new reality where the lines between regulated and unregulated finance have blurred, embedding shadow banking into the very fabric of global economic activity. As we move toward understanding the scale of this influence, it becomes clear that shadow banking is no longer a peripheral force. It has become the central nervous system of international capital flows. The shadow banking system has evolved from a subtle undercurrent into the very bloodstream of global finance. Today, it accounts for over $100 trillion in assets worldwide, more than the combined GDP of every nation on Earth. This vast network fuels 70% of cross-border trade finance, enabling the movement of goods and capital across continents without the oversight of traditional institutions. Central banks, once the sole providers of liquidity during crises, now increasingly rely on shadow banking channels to stabilize markets. As seen during the pandemic and subsequent economic shocks, private credit markets have grown to rival traditional bank lending, offering faster, more flexible financing to businesses and governments alike. This dominance has created a new financial reality where the most critical flows of capital operate beyond the reach of public scrutiny. The speed and scale of shadow banking allow it to respond to market demands in ways that regulated systems cannot, making it indispensable for global commerce. Yet this very efficiency masks a deeper fragility. As the system expands, the lack of transparency makes it impossible to fully assess risks. While leverage ratios often exceed 20-to-1, creating vulnerabilities that could ripple through the entire financial ecosystem. The next step, therefore, is to examine these hidden cracks before they threaten to destabilize the very foundations we depend on. The system's very efficiency masks a deeper fragility. Without transparency, the true extent of risk remains hidden, like a storm brewing beneath calm waters. Shadow institutions operate with leverage ratios often exceeding 20-to-1, creating a house of cards that could collapse with even a minor tremor in the market. Contagion spreads rapidly through interconnected networks, where a single failure can trigger a cascade of losses across continents. During times of stress, the absence of central oversight leaves regulators scrambling to understand what is happening as the shadow system functions in the dark. These hidden cracks are not merely theoretical, they represent real vulnerabilities that could destabilize the global financial order at any moment. This fragility sets the stage for the next shift in power, as new financial hubs and private capital reshape the landscape. The cracks in the shadow banking system we've just explored aren't merely vulnerabilities. They're catalysts for a fundamental reshaping of global financial power, as traditional institutions grapple with their own fragility. New centers of influence have emerged, quietly altering the economic map. Asian financial hubs like Singapore and Hong Kong are no longer just extensions of Western finance. They're developing their own ecosystems for shadow banking, offering alternatives to Wall Street's dominance. Meanwhile, Middle Eastern centers such as Dubai and Abu Dhabi have become unexpected powerhouses, leveraging sovereign wealth funds and strategic partnerships to create sophisticated financial corridors that bypass traditional oversight. This shift isn't just about geography. It's about autonomy. Emerging market economies are gaining unprecedented financial independence, using shadow banking channels to access capital without Western intermediaries. Private capital now plays a decisive role in national economic policies, where venture capital firms and private equity firms can influence everything from infrastructure projects to energy transitions. Central banks, once the undisputed architects of monetary policy, find themselves adapting to this new reality. They're developing new tools to monitor unregulated flows, recognizing that the shadow system has become too vast to ignore. As these dynamics play out, the balance of power continues to shift in ways that challenge long-standing financial hierarchies, setting the stage for the evolving landscape of today's shadow banking world. As the shadows of financial power continue to shift, the landscape of shadow banking has evolved far beyond its origins in opaque credit networks. Today, it seamlessly integrates with the digital economy, where stablecoins and crypto platforms now serve as conduits for unregulated capital flows. These technologies, once dismissed as fringe, have become central to shadow banking's modern ecosystem, enabling near instantaneous transactions across borders while bypassing traditional oversight. Regulatory efforts like Basel III attempt to rein in these forces, but their reach remains limited against the speed and scale of digital innovation. Central banks, those still grappling with the complexity, are developing new tools to monitor these unregulated channels, recognizing that the old frameworks of financial control are no longer sufficient. Despite these measures, shadow banking continues to expand, driven by demand for faster, cheaper credit and the allure of regulatory arbitrage. Private credit markets now rival traditional banking in scale, particularly in emerging economies where institutions are increasingly turning to shadow channels for financing. This growth is not without consequence. The very tools meant to foster financial inclusion can deepen global inequality by favoring those with access to digital infrastructure. Yet, as central banks refine their monitoring capabilities, a new phase of financial governance begins to emerge, one that acknowledges the shadow system's dominance while striving to mitigate its risks. The stage is set for a broader reckoning, where the interplay between innovation and regulation will determine how power flows through the unseen currents of global finance. As we move beyond the immediate landscape of shadow banking, its influence on the global financial map becomes increasingly apparent. Shadow banking doesn't merely operate alongside traditional systems, it shapes them, particularly through its deep connection to the dollar's dominance. The US currency remains the backbone of global trade, and shadow banking channels are the arteries through which liquidity flows, reinforcing America's economic leverage. For emerging markets, this means access to capital is often dictated not by sovereign policy, but by the invisible rhythms of unregulated finance. This dynamic, while enabling growth, also entrenches global inequality, as capital flows favor those already integrated into these shadow networks, leaving others on the periphery. The next phase of financial evolution will test whether these systems can be harnessed for broader inclusion or continue to deepen divides. As we look toward the horizon, shadow banking is poised to evolve in ways that could reshape global power even more profoundly. Artificial intelligence will likely automate credit assessments and risk management within these systems, making them more efficient but less transparent. This could deepen the divide between nations that control these technologies and those left behind, as algorithmic finance becomes a new form of economic leverage. Meanwhile, climate finance may become a critical frontier for shadow banking, with unregulated capital flowing into green projects without proper oversight. Decentralized finance platforms might challenge traditional shadow banks, yet they risk replicating the same opacity and inequality. The question remains, will these innovations foster inclusion or entrench existing power structures further? The next chapter will reveal how these currents shape our shared future. The currents of financial power have always flowed beneath the surface, shaping empires and economies without fanfare. Like the tides that carve coastlines over centuries, shadow banking has evolved through history, adapting its tools while preserving its core purpose, to move capital where it is most valued, often beyond the reach of oversight. Today's algorithms and decentralized platforms may seem novel, but they echo the medieval money changers and 19th century merchant banks that once operated in the shadows. Power does not vanish with new technologies. It merely transforms, finding new channels to exert influence. The question is not whether shadow systems will continue, but how they will reshape the world's economic landscape. As we stand at this crossroads, the patterns of the past remind us that financial systems, like empires, rise, transform, and pass on, leaving behind only the echoes of their unseen influence.